I did mention that this AI bubble talk continues to lead many conversations. There's a tech conference in Italy, Goldman's David Solomon and the Amazon founder Jeff Bezos both speaking there, both making some interesting headlines of the current environment. Solomon, quote, "People are out on the risk curve because they're excited. There will be a reset, a check at some point, a drawdown." Bezos, quote, "Investors have a hard time in the middle of this excitement distinguishing between the good ideas and the bad ideas. That's also probably happening today, but it doesn't mean that anything that's happening isn't real. AI is real. It is going to change every industry." He talked a lot about a good bubble, one that's industrial, not financial. What do you make of those comments and the overall conversation that I think more people are having?
Sure, investors are excited, and sure, it is real. I mean, we've experienced supernormal growth in these companies over the last 5 years, annualizing at about 40% a year growth. And we're in the part of this cycle where capex is really, really heavy. But remember, we're going to move from a period where capex is heavy and new leadership is going to emerge because it's going to move to the application of the technology. We're just not there yet. We're not willing to admit that we're there yet.
Are you concerned at all about a bubble based on all of the capex that's going on and some of the conversation that's out there? The Solomons, people are excited. They're out on the risk curve. Bezos, people can't distinguish between the good ideas and the bad ideas, so you just throw money towards everything and hope everything works, but inevitably nothing all works, right? It doesn't always all work.
When we talk about bubbles, we tend to lean towards valuation, and we all pay attention to valuation on this show. But it's when the earnings trajectory is going to show. When you're going to see that change is when capex starts to slow. We're seeing really no signs of capex slowing. And so until you see that pivot point, I think it's going to be more of the same, as we've said before on the show. But at some point, you're going to have to switch from the cyclicals, the semis, the Mag 7s, to the application of this. I think there's a lot of hope that you're going to see a broadening out in this market, too, which we have not seen. The cap-weighted indices are doing really well. The others aren't. And so I think we're more of the same, at least through year-end. And I think that's probably what propels us to, 7,000 on the S&P.
I mean, Steph, you could be just years before you get into any kind of bubble trouble, as we learned in 2000. Greenspan made his thing 4 years before the irrational exuberance thing, 4 years before the whole bubble burst. So I guess these conversations are useful to try and take stock, if you will, on where we are. If history is repeating itself, if it's at the very least rhyming. To Rob's point about capex, wow, Bank of America is so bullish on capex. We expect annual investments to nearly triple between calendar year 25 and 30 to over $1.2 trillion plus, constrained only by the ability to scale buildings and power. So this isn't stopping anytime soon. Whether it inflates a gigantic bubble, one won't know until probably it's too late.
Yeah, I mean, I think we're in very early innings. CapEx is not just coming from the technology companies. It's coming from several different industries, the industrials, the utilities, the pipelines, the power companies, et cetera. So it's not just AI. It's data center, it's grid, and it's power. And Tom Fanning, who's the ex-CEO of Southern Company, was on CNBC last week talking about how we're going to need 24/7 capacity and energy, and we just don't have it. So I just think that this is very early innings. I think that you can play it a number of different ways. It's not just Mag 7. We talk about the industrial companies all the time, building out data centers and building out the grid. It's the IPP companies. It's the utility companies. So that's why I don't think it's a bubble. Because
some say those are in a bubble.
I don't think so. I don't think so, because you have this massive investment across every different industry.
Yeah, but
that's why I don't think it's a bubble.
Hoping that it all pays off. And
the cost actually, the financial services companies are talking about the cost coming down from using AI like by 30 to 40%. And a lot of that is going to lead to job losses eventually, of course, but they're saying that it is very beneficial to use AI. I think we all would say that, but it's the real numbers that prove that it is such a strong trend.
Okay.
And it's the ROIs. Companies are seeing ROIs, monetization. Ask Meta.
Okay. So on the notion of what inning are we in? Josh, Morgan Stanley's Lisa Shallett takes a crack at that this week, earlier in the week. and said, quote, given the Gen AI capex story's centrality to both markets and the economy, the most important question for investors in the next year is what inning are we in? When it comes to market discounting scenarios, we believe we are closer to the 7th than the 1st, and we're starting to see cracks. All based on this idea that capex is going to carry this market until it doesn't. What do you think?
I'm not smart enough to be able to pinpoint what inning or even tell you whether it's the earlier or the later innings. What I can tell you, and I think I am qualified to say this, there's going to be a correction, even if we're only in the 1st inning, as the technologists would tell you. There's just absolutely no way you can have stock prices, hundreds of companies, all revolving around this theme, spread out from industrials to utilities to communications to semis, software. You cannot have this level of activity and bullishness and Empire State Building-esque vertical charts in perpetuity. It's never happened before, and it won't happen this time. There is absolutely going to be a reckoning. That's not a reason to not invest, because as we've seen over the last 15 years, corrections happen really fast. People don't even get a chance to panic if and when they happen. So I don't think that should keep you out of these stocks or being in the market. I just think people need to calm down. Maybe the right focus is position size rather than some sort of binary in-out decision. And now I'm going to say something that's going to sound ridiculous on its surface, but give it a few hours, think about it later. You'll recognize how profound it actually is. The only thing that will keep this rally, just hear me out and you'll understand.
Go ahead.
The only thing that will keep this rally going is if the rally keeps going. And I know that's a tautology, but the entire premise of the bullishness around this AI theme is emanating from the performance of the stock prices. When did Mark Zuckerberg stop spending money on the metaverse? When his stock price fell by 70% and people were on TV demanding an apology from him. If and when we start to see stock prices stop reacting positively to continued AI capex spending expansion, that's when this will end. Only down stock prices can put an end to the rally. I don't think we're there yet, because every time one of these companies says, hey, remember we said we were going to spend X, turns out it's Y, the stock price goes up 10, 15%. In that environment, why would a CFO and a CEO look at each other and say, let's slow down? They're being rewarded for speeding up.
I hate to inflate a very big head already, okay? But I think he's spot on here. The stock market is what's driving confidence. You're seeing it come in through some of the consumer data. It's all the high-end consumer. And as far as this goes, the minute you see a crack, which is why capex is so important, it's when confidence is going to wane. And I think if you get out of the market now, let's all recognize that if you're early, you're wrong. That's it. The market has punished you for that. And so everybody keeps going on the same path.